From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. Once again, yields taking center stage. Yields up, stocks down. S&P futures lower by about 0.6% as you see. Yields climbed to the highest levels going back to 2007. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
We begin with the big issue, torn between earnings resilience and inflation concerns.
Resilience has been the key word.
There is some positive news on earnings.
They're actually pretty resilient.
Earnings so far have proven indeed to underscore that story of resilience.
The bar is low.
Companies have a lot of levers to pull and use in order to engineer better earnings.
Company earnings do not yet reflect the wider macroeconomic expectations.
You can have a weaker economic environment and actually a solid earnings environment.
But I do think downgrades are still coming to 2023 earnings.
Inflation was supposed to be moderating.
Now it looks like we're going into extra innings.
Wage pressures are pushing into prices now.
This is presenting a real challenge for not only the Fed, but the broader economy.
There's a game of chicken going on right now.
The Fed on one side versus earnings on the other.
Joining us now, I'm so pleased to say, Morgan Stanley's Lisa Shallett and BlackRock's Tony DeSpirito. Lisa, starting with you. Yes, earnings have come in better than expected, but is it good enough?
The question is good enough for what? I think the fundamental issue is that this is a market that has extraordinary impatience, and just wants to quote unquote be done with it already. And I think that the frustrating piece of this is that Q3 earnings are not allowing us to see that capitulation, that rebasing and resetting of 2023 earnings expectations yet. There's still a huge tailwind of the power of nominals or pricing power and inflation in the results we're getting. And so, the commentary about resilience, I think, is going to ultimately prove to be a head fake, but it's not yet a clearing event that sets up for a durable, viable bottom in this market.
Which really raises an issue, Tony, of whether these earnings are really relevant, given the lack of visibility and given that we might not have seen the weakness yet, but it will still come.
So I do think third quarter earnings, unfortunately, are a lagging indicator, not a leading indicator. The Fed just started raising rates this March, and that first increase was 25 basis points. That was 7 months ago. And we all know it takes time for Fed rate increases to impact the real economy and earnings. It doesn't even start for 6 months, and then the peak impact is really 18 months down the road. And of course, the Fed has done a lot in a short period of time, right? 300 basis points since the beginning here. So I don't think we've felt the full impact yet. And so I do think in the near term, that means bumpiness in the market. And there's still some good news there. I think the good news is there are things that, as asset allocators and portfolio managers, we can be doing to build more resiliency in our portfolios. And then as I look longer term, I do think valuations are certainly much more attractive today than they were at the beginning of the year. And that does spell better things for long-term returns. So I do think it's important to stay invested, but to prepare for more volatility in the near term.
And Lisa, do you agree? I mean, B. Riley's Art Hogan sees Q3 results as a potential catalyst for equity, saying, quote, what is important to remember is that second quarter earnings came in much better than feared, sparking a solid July rally. There is a credible possibility that history may repeat itself this go around. Perhaps, and even your colleague Mike Wilson may agree with that, but do you agree with Tony that this actually could be part of a longer term gaining cycle? So it's okay if there's some volatility on the downside after that?
Absolutely. I mean, I think we're going to be on this roller coaster to nowhere, where periodically we're going to get these bear market rallies where as I said, that this is a very impatient market. Investors seemingly have no tolerance for pain, and so any sign that the wind may begin to blow their way gets a 2 or 3 day rally going. But I completely agree with Tony that we have not seen the real impact of tighter financial conditions and tighter monetary policy on either the slowing in the economy and or corporate earnings. So that is still in front of us. We still need to rebase numbers. And unfortunately, it doesn't look like Q3 is going to be that, capitulative, event that pushes those 2023 and 2024 numbers down to where they probably ultimately will go.
So what do you do with this, Lisa? I mean, do you basically sell the rally now and prepare for whatever downturn comes after we start to get more of a sense of that bleed through of higher rates?
No, not at all. So we also agree with Tony that this is a time to be fully invested, but it's a time to be fully invested in an asset allocation that acknowledges the environment that we're in. And that environment is this very sideways change of leadership, end of a cycle, beginning of a new cycle, type positioning, which means you've got to be ultra diversified. You've got to, really take advantage of where the bond market is right now. We believe that the bond market is much further along in discounting this Fed cycle than the stock market. We like investment grade, particularly, in the shorter to intermediate duration. And within stocks, we are looking for value. We are getting opportunities to be active stock pickers, and we're seeing it, in various sectors, in various geographies, especially with the dollar, and in multinationals are very interesting to us right now. We're seeing it by factors. Exposure, so we're not growth or value. So we're to pick our spots, but there are opportunities in this market. We're just going to have to be patient.
Talking about some of the consumer-facing internationals, multinationals, there have been a string of beats headlining third-quarter results in the past 24 hours, including some of those multinationals like Procter & Gamble. We also have got Netflix and Nestle. For more, let's bring in Bloomberg's Taylor Briggs. Taylor.
Yeah, Lisa, I mean, for the most part, it has been a little bit better than expected. Some of this could just be the lowered, again, expectations coming into this. But when you think about the numbers, they're still looking at about 2% growth on earnings on a year-over-year basis. And, of course, relative to expectations for both the sales and the earnings, it is coming a little bit ahead. And you also highlight 9% sales growth on a year-over-year basis, highlighting some of that price pressure, of course, that some of these companies are able to pass on through to the consumer. I want to caution, it is very early days. There's still a long ways to go in this season, but so far, here's how we're thinking about things by sector. You mentioned Netflix, a huge blowout yesterday. Communications has actually been a little bit of a laggard in terms of where we are versus estimates, expectations. But down at the bottom, you can see some of the big sort of outperformers have been discretionary. It's been industrials. And then, of course, there's been some of the utilities as well that are doing okay as long as bond yields stable out here. I think at the beginning, Lisa, I mentioned where we are relative to expectations, because all of this is sort of the positioning coming into the earnings season. We are now looking at 19 straight weeks of earnings revisions lower. So if you set a bar low enough, you're bound to beat it, I suppose.
Taylor Riggs, thank you so much. Lisa Shallot and Tony DeSpirito still with us. Tony, what's your take in terms of what the signal is to get from earnings, especially given the fact that you've got the likes of Goldman Sachs saying we haven't priced in recession, there's further downside to go. A lot of people seem to agree, and yet we're not seeing it now. We're going to possibly see it at another time.
Yeah, so I think the thing to do as investors is to both be positioned for resiliency as well as try to be offensive in unique ways. So, for example, I think of a barbell strategy between cyclicality and stability, and I think you can add value there on both sides. For instance, on the stability side, you talked about utilities earlier. I think healthcare is a way better way of getting stability than utilities. Utilities and staples are very expensive for what they are. They have premiums of roughly 20% versus the market. Historically, that's not been a good time to invest in those sectors. On the flip side, healthcare is trading at a discount to the S&P 500, despite the fact that earnings resiliency for healthcare has shown to be extremely good in periods of recession. So you got earning resiliency and valuation That's in the fund I run, the equity dividend fund, that is the single largest overweight, for example. And so I think that's a way that you can be aggressive in your portfolio, for example.
Tony, I'd love to go a little existential. And we were talking about this, Lisa talking about how some of the rate structure hasn't been fully realized in equities just yet. And we've been talking with people about how we have not seen the highs yet, and we have not seen where we end up. We are not going back to 0% rates. Where do you think that we're going to see the biggest pain in the equity structure, and can equities still be as value driven as they have been in the past with that kind of rate structure?
Yeah, so we run a model, an equity risk premium model, which is basically a stocks versus bonds model. And if you look at it, actually, so this is where I would disagree with Lisa. I do think the equity markets have priced in current rates. Based on our model, the equity risk premium is smaller than it was at the beginning of the year, but it's still larger than historical averages. The margin of safety there is rates could increase another 70 basis points on the 10-year before that would flip to, say, buy bonds over stocks. And so that's what we're seeing. The other thing that we're seeing that's kind of interesting is growth versus value. You know, growth valuations have come down pretty dramatically this year. They're now at a normal level, so they've corrected. Yet the valuations of value stocks are still really low PE multiples. And one of the insights I think there is for asset allocators that we wrote about in our latest quarterly is barbelling growth and value is better than buying the stocks in the middle. The stocks in the middle actually look pretty overvalued, whereas growth and value both look attractive.
Well, and Lisa, weigh in on this. Do you think that stocks have fully appreciated, as Tony was saying, perhaps rates right now, perhaps not where rates will go by the end of the year, but where they'll end up once we get post this pandemic-driven inflationary surge?
No, we look at the equity risk premium a little bit differently, and we think that, this has been a market where equity risk premiums have actually been below average given the amount of risk that's out there. That having been said, I do think that we agree on this barbell strategy. We do like more stable or growth or even defensive names in healthcare. But for us, we're barbelling against that stability with things like industrials, things like energy, things like the defense industry as a way of kind of, stock picking, quite frankly, in this environment. Because again, at the index and beta level, at that S&P 500 index level, that we're just not convinced that mega cap tech, which dominates those indices, have really priced the reality of higher for longer, maybe forever.
Lisa Shallett, Tony DeSpirito, both of you sticking with us. Some breaking news crossing right now. Abigail Doolittle has more. Abby.
Hi there, Lisa. Well, we do have breaking news headlines crossing the Bloomberg terminal regarding former President Donald Trump and the classified records probe. Prosecutors see evidence for bringing obstruction of justice charges against the former president. No decision has been made, but Justice Department prosecutors believe there is sufficient evidence to charge Trump. The path to an actual indictment is a little bit less clear. Timing, politics. And Lisa, this is not necessarily new, but it seems as though maybe they have a bit more evidence in this direction around the mishandling of those classified records. Again, there's a possible charge of obstruction of justice against Donald Trump, and it's not likely anything will happen, I guess, ahead of those November 8th midterm elections. But one former member of the FBI does think that this could happen by the end of the year.
Abby, thank you so much. Coming up, UK inflation hitting double digits yet again.
People are struggling. It is difficult at the moment. That's why we put in place the energy price guarantee. We've delivered the energy price guarantee. We've helped people this winter, and I will continue to do that.
That conversation still ahead. 17 minutes to the opening bell with futures lower. And we do have 0.6% decline, 37.09. This is Bloomberg.
Honest about the mistakes I've made. But what I don't apologise for is the fact that we have helped households through this winter, through the energy price guarantee, the fact that we've reversed the national insurance rise, and the fact we are taking action to get our railways running.
brutal PMQs where she was accused, Liz Truss, of not being able to keep her word for more than a week and not really being the true leader of the United Kingdom. UK inflation hitting a 40-year high again, adding yet more pressure on policymakers to act, even as markets remain on edge with all the political back and forth. This coming as investors look for an FX intervention over in Japan as the yen hits a 32-year low against the dollar. Team coverage starting right now. Let's start with Lizzie Burden in Westminster. Can we just get a sense of how controversial those PMQs were and where that leaves Liz Truss's prime ministership?
Well, I was speaking to a Tory MP after this session of Prime Minister's questions, and he said at least she turned up, which shows just how low the bar was for this performance. The big surprise was that she said she's committed to the triple lock on pensions, which guarantees that pensions will rise with the highest of earnings inflation, or 2.5%. It was a big surprise. It surprised the newspaper editors who'd been briefed that they were going to drop this commitment, or at least that it was under threat. It makes a fool of newspaper editors when she needs them on side. It makes a fool of the ministers who were briefing it, and it makes her Chancellor's job even harder because he's going to have to plug that £40 billion hole in the public finances somehow else. It raises the question of whether she'll raise benefits in line with inflation, because Hunt has said that he's going to protect the most vulnerable. And as you say, we've now got back to double-digit inflation, so there is huge pressure on him to help them out. It really smacks of incompetence. Very, very weird decision.
And meanwhile, people are looking for the Bank of England to make a bold move to try to counteract some of the inflation on the other side, possibly creating more disruption. Meanwhile, over in Japan, yet more potential policy turmoil. The speculation of this has been running for a long time. However, we are reaching levels that become unsustainable, certainly for policymakers, certainly the speed at which the yen has been weakening. Damian Sassower here for more. What do you think is the threshold for some sort of intervention as we see the yen bump up, or down, I should say, against 150 with the dollar really strengthening?
Well, Lisa, you just hit the nail on the head. It's all about the speed of the move. That's all that matters, right? I mean, you can continue on with yield curve control in Japan. You can even change from the 10-year to the 5-year as a target, or even move the band a little bit wider. But at the end of the day, it's all about the fact that Japan has plenty of reserves and they're willing to defend their currency as far as it will go. Well, we'll see about the speed and we'll see how it goes. What I'm most focused on is the broader Asian region, because what you're seeing is FX reserves globally are down 8% year to date, a lot of it due to the dollar strength relative to the developed market peers. But I mean, my goodness, you're seeing reserves get pummeled, and in places like Indonesia, Malaysia, the Philippines, they're already engaging in all forms of intervention, Operation Twist. You hear people on the tape each and every day. So it's not just relegated to Japan or the UK, it's expanding to the whole of EM as well.
All right, Damian Sassower, Lizzie Burden, to both of you, thank you so much. Still with us, Tony DeSpirito and Lisa Shallett. And Tony, at what point does the rest of the world's problems become the U.S. problems?
Yeah, so I mean, the rest of the world problems have been mostly caused by the strength in the dollar. And so I don't think it works that way. Usually it works the other way. U.S.'s problems become the world problems. And so I'm not super concerned, but I'm watchful. Watchful of market dislocations like what we saw in the U.K. And certainly when you think about what could cause a Fed pivot, these are things that are on the list.
Lisa, we were talking about multinationals being a potential opportunity. Where is that versus a potential liability given some of the foreign sales at a time of dollar strength?
Yeah, look, I mean, I think this is one of the conundrums at the minute, which is, for U.S. companies right now, the strength in the dollar has gone from, a non-factor to a negative factor. For the U.S. economy as a whole, however, the very strong dollar has actually, believe it or not, kept a lid on inflation, given the percentage of our economy and our consumption that we import. And so one of the interesting dynamics here is whether or not the U.S. dollar at some point in 2023, when that potential Fed pause or pivot comes, does that weakening dollar then actually become a liability for the Fed because it's very destabilizing vis-a-vis declining inflation. So these are really complex cross currents. We're seeing extremes in this cycle in terms of U.S. dollar strength, not versus emerging markets, which we very often see. Emerging markets actually on the whole have been resilient and have held up. But we're seeing these devastating discontinuities, but with our key trading partners like the UK, like Europe, and like Japan.
Lisa,
and destabilizing.
How focused on the U.S. are you in terms of your investment portfolio? I mean, are you basically completely overweight, hiding out in the U.S., or are you starting to dabble in some of those emerging markets or even the United Kingdom?
We absolutely are dabbling. We think that there are some very, very good value opportunities. We're leading with EM right now in terms of our interests, but we are, again, as I noted, we're scrambling through and searching through the wreckage for those multinationals in Japan, in Europe, in the UK who are going to make hay on a global competitive basis with their currencies where they are.
Tony, final word on this point?
Yeah, so I run a large cap U.S. value fund, but as part of that, we look at multinationals in other geographies because they're competitors to the U.S. companies we're looking at. Right now, I've got about 20% of the portfolio in non-U.S. companies. They're all multinationals. A lot of companies in energy or pharmaceuticals, what we're finding is a headquarter discount, so very similar business models. I'll take energy, for example, the U.S. integrateds versus the European integrateds. There's a huge multiple gap there, with the European integrateds being almost half the multiple of the U.S. But you look at the business mix, incredibly similar. So that's a better deal. And so that's when we'll stray outside the U.S. to get that better deal. Energy is an example. Also pharmaceuticals. That's the other place where we're seeing opportunities outside of the U.S.
Lisa Shallett, Tony DeSpirito, thank you so much. Fascinating about international, multinational companies outside of the U.S. Coming up, the morning calls, and later Invesco's Kevin Holt looking for earnings estimates to keep coming down. He and a lot of others, he'll be joining us around the opening bell. Right now, that softness hanging in there around 0.6 of a decline, 0.6%, 37.11. This is Bloomberg. Countdown to the open begins. I'm Lisa Abramowitz in for Jonathan Ferro. You do see yields surging past 4.5% on the 2-year, and you see stocks lower. 0.7% decline on the NASDAQ, 0.6 decline on the S&P. Time now for the morning calls. First up, Baird upgrading Lockheed Martin to outperform. $513 price tag, highlighting the stock's attractive valuation and improving outlook. Next up, Evercore downgrading Best Buy to inline, expecting elevated inventory levels to keep pressuring margins. And finally, JP Morgan upgrading Netflix to overweight, pointing to the company's impressive quarterly results. They didn't at least fail. That was where the bar was at, and they surpassed. Coming up, big tech earnings kicking off. Invesco's Kevin Holt expecting higher inflation to mean lower tech stocks. That conversation coming up next. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of trading, we do see losses across the board after trying to get up and a little bit more optimistic following some of these earnings. The NASDAQ leading the charge, down 0.7%. S&P right there with it, down 0.6%, really led by yields. Yields higher, stocks lower. That is what we've seen consistently. And right now, people are starting to get adjusted to inflation that keeps beating to the upside, keeps pressure there. 10-year yields hitting at one point, and currently the highest levels going back to 2008, near 4.1%. The euro weakening, 97.85 versus the dollar. Crude just edging up, but really right now the story is very much in the yield space, with 2-year yields hitting the highest going back to 2007. Joining us now with a look at the stocks moving at the opening bell, Abigail Doolittle. Abby.
Well, Lisa, we are looking at our first down day in a few days, and not surprisingly, as you were just talking about, rising yields pressuring stocks overall, but especially big tech. Take a look at Apple right now, down 1.2%. Valuation more of a concern and when yields rise, that repricing of risk. JP Morgan Chase, banks also not really getting a bid, even though yields are higher. That's been the story of the year, probably because the yield curves are coming in just a little bit. But JP Morgan Chase well off of its 1% lows. Plus, that stock's been up a lot in recent days off of that good quarter, and maybe it's going to flip right now. Spirit Airlines up 2.2% on the news that the shareholders have backed a $3.8 billion purchase by JetBlue. Of course, there's been this back and forth between JetBlue and Frontier, but right now it does appear that shareholders are approving this deal with JetBlue, and they expect this deal to close no later than the first half of 2024. That's a ways off, so let's see what else happens in this story. And then finally, Netflix heading to its best day since January of this year on a monster quarter. Growth is returning, and they're looking at a forecast of 4.5 million subscribers for the fourth quarter, and that is really helping the stock out in a big way on the day, Lisa.
Actually, growth, not shrinking. Abby, thank you so much. Let's stick with Netflix. CEO Reed Hastings applauding his company's return to growth. Take a listen.
Well, thank God we're done with shrinking quarters. So that's the big feeling of we're back to the positivity. We still got FX, so that's a huge hit, as we've explained. So that's not going to go away. But other than that, all the stars are lining up very well for us.
Reed Hastings taking it religious. Bloomberg's Ed Ludlow joining us now for more. Ed.
Yeah, 2.41 million subscribers in the quarter, double what they had forecast. 4.5 million new net subscribers come in the current fourth quarter. The street likes the story. They like the visibility on the growth trajectory. They like the idea that an ad-supported tier comes this November. They like the idea that password sharing will be charged as of next year. There are headwinds still, though. They spoke about the stronger dollar, right? That's going to mean a $1 billion hit to revenue and an $800 million hit to profit. Even so, the street's still bullish because they believe that an ad-supported tier will increase subscribers by a meaningful volume. This is a company that's having strength globally, right? Korea was a strong point in terms of local language content, which helped to drive growth. They're also strong in markets like Latin America and other parts of Asia. Interestingly, despite the guidance for the fourth quarter, they are going to suspend forecasting quarterly subscribers. This is a company where executives have been banging their head on the armchair saying, please stop getting so obsessed about subscriber growth. Look at our traditional financial metrics. In the quarter, a beat on the top and bottom line. But again, take into account that stronger dollar. We knew this earnings season it would have a factor, and it has done so for Netflix.
Ed Ludlow, thank you so much. United Airlines, the latest to clock an earnings beat, joining the ranks of Procter & Gamble, Netflix, as we were just talking about, and Nestle. Bloomberg's Taylor Riggs is back with us for more. We were just speaking with Scott Kirby of United. What's the latest?
Wild, Lisa. 4:30 yesterday after the closing bell, we get comments from United Airlines saying that the COVID recovery trend will really overcome any recessionary fears. And for me, that is the statement. And then, of course, when they come out and they say that the fourth quarter adjusted operating margins will also exceed 2019. So that really shows the pricing power amidst some of the capacity declines and the strength of United Airlines. Let's talk about some of the inflationary pressures with some of the other big earnings, of course, that we're getting also this morning. Procter & Gamble, one of them, like Netflix, highlighting the strength of that dollar. You know that the pressure that puts on overseas revenue in a different currency, and when you translate onto a dollar-based balance sheet, then the pressure that causes. Adobe facing a similar story, a 4% currency headwind there, but otherwise sales looking about $19 billion for the full year. Intuitive Surgical is an interesting one, also raising that full year growth to 17 to 18%. Previous estimates had been around 15%, and a lot of analysts are seeing some strength within hospitals, still spending on some of these. Abbott, of course, is just a decliner as well, looking at some decline in revenue and profit after those baby formula shortages. But overall, Lisa, it has been a relatively good season here so far.
And the bar had been pretty low, and people initially were pretty happy with it, although we'll see whether yields continue to erode that. Taylor Riggs, thank you so much. Dollar gains starting to cut into third quarter results, as we've been talking about. P&G, Netflix, Adobe, all warning of the side effects. Let's bring in more with Kaylee Lyons. Kaylee.
Well, Lisa, Taylor was just talking about P&G, where you're definitely seeing this showing up. They're saying their full year profit is going to be at the lower end of the forecast. They talked about a number of different headwinds, one of them being foreign exchange, that stronger dollar. Ultimately, foreign exchange having a negative 6% impact in sales for the fiscal first quarter. You also have, of course, the pricing issue. They're facing higher input costs, but what that means is they are passing those higher costs on. Pricing up 9% in the quarter. So overall, that led to organic revenue growth of about 7 percentage points. That is, of course, the inflation issue coming through. To get back to the dollar, though, P&G, not the only one warning about this, as you said. We heard it from Netflix too. Ed mentioned it. That's part of the reason the sales forecast came up short. But the list is much longer than that. Basically, every multinational company is going to face this in some shape or form because, as Taylor said, all the money you make overseas in weaker currencies is worth a lot less when you have to translate it back into dollars at the other end. And that is likely why we have seen companies with high international sales exposure underperforming those with low international exposure. And as for what those companies are, a lot of them are technology companies. If you look at the international revenue exposure as a percentage of revenue for sectors in the S&P 500, it's 52% for technology. Of course, we're going to get a lot of those big tech names reporting results next week, so watch out for that dollar keyword. And you have materials and communication as well as staples and financial, which of course we've already been hearing from. Lisa.
Kaylee Lyons, thank you so much. Right now, joining us, Invesco's Kevin Holt, who sees further downside in stocks as an opportunity, writing, quote, stocks are likely to see continued valuation compression and earnings estimates will need to come down. We see the S&P 500 becoming more compelling around 3,000 to 3,400. And as cyclical equities further discount economic concerns, we will look to build exposures. Kevin joins us now. And honestly, Kevin, it's amazing to see how people talk about the bearish cases, how far they go down as a sign of optimism. How far away are we from that right now as we get 3,700 on the heels of earnings that have been better than expected?
Yeah, so it's, I mean, I would say one thing, earnings have been better than expected so far, but we've had a lot of financial stocks where interest rates have gone up, so they've been the beneficiaries of that. I think as we get further into the earnings reporting season, you're going to see more stress. You can see from P&G results, which you guys just talked about, there's going to be a lot of pressure on the consumer. And as that, consumers 2/3 of the U.S. economy, so as that pressure builds, it's going to become difficult. But I think we're all looking for inflation to peak. And when inflation peaks, even though earnings may continue to go down, I think that's a signal that we can look to and say, okay, now it's time we can really get back involved. And we're not there yet. So probably Q1, Q2 of next year is my estimation of hopefully when things will bottom out on an inflation basis.
Kevin, we were just speaking with Lisa Shallot and Tony DeSpirito, and they were talking about liking multinational companies outside the U.S. who could actually have the reverse kind of effect of some of the multinationals in the U.S. that are seeing the dollar as a headwind and having it actually be a tailwind. Do you have a similar kind of perspective as you try to invest in something, preparing ahead for perhaps a better opportunity to buy?
Yeah, so we don't, I mean, having a 5-year time horizon, which is a little bit longer than probably most investors, we don't really, we look at currency probably as more transient. With a lot of the geopolitical issues that we have going on right now, I think the dollar is artificially strong. Could these geopolitical issues continue on indefinitely? Possibly, but I think that's unlikely. So we view the dollar as being, extremely high, being a transient issue, and we're not really letting that affect our investment decisions.
With a 5-year time horizon, Kevin, how do you game out where we're going with the benchmark rate and the valuation prospect longer term for really where these valuations ought to be on the equity side?
Yeah, so we are using history, and it is difficult when we haven't, most of us have not been through an up interest rate cycle. So I think you have to look at the normal multiple historically is 15, 16 times. And that's kind of where my 3,000 to 3,400 come out in terms of earnings are coming down from probably about 250 expectations for 23 to that 210 to probably 220 level for next year. So that makes me think that we'll kind of bottom out around there. With that said, I think a lot of the inflation issues in terms of oil, I don't think oil is going to get better. I don't think it's going to get a lot worse. I think food, as soon as we can rectify some of the situations or hopefully the Ukraine-Russia situation resolves itself, that situation will resolve itself. Wages, probably a little more difficult. That's probably a 1 to 2 year time horizon, and the same with rents. But as we kind of approach, I think we still go back to a positive backdrop. I'd be very constructive on a 3 to 5 year basis right now. It's just the next 6 to 9 months that I think are a little tricky.
We're going to continue the conversation coming up. Invesco's Kevin Holt will be sticking with us. Coming up, we've got the Biden administration planning another SPR release.
The president's going to announce 2 things today. The first is additional 15 million barrels for December out of the SPR. Second, he's announcing a plan and a policy to refill the Strategic Petroleum Reserve when the price of oil falls to about $70 a barrel.
Conversation still ahead with President Biden's energy advisor, Amos Hochstein. That's coming up. This is Bloomberg.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Jim Bullard, St. Louis Fed president. That conversation at 3:30 p.m. in New York, 8:30 p.m. in London. This is Bloomberg.
I'm Lisa Abramowitz in for Jonathan Ferro. For our viewers worldwide, we're now joined by Amos Hochstein, Special Presidential Coordinator for Energy Security from Washington, D.C. Amos, thank you so much for being with us. I want to start with what President Biden has talked a lot about, which is the release of the Strategic Petroleum Reserve, an additional one, as prices climb a bit, but are still just $3.85 relative to the $5 a barrel that we saw earlier, or $5 a gallon that we saw earlier in the summer. Why do an SPR release now, given the fact that prices have come down as much as they have?
Well, first, good morning, and it's a pleasure to be with you again as well. Look, the president has been committed over the last many months to take every action to keep oil prices down and translate that into keeping gasoline prices down. So we're doing two things today. One is the release of 15 million barrels, which, as you know, when we announce it today, these barrels will come on the market in December. When there may be other events happening in oil markets, and as a result of whatever Vladimir Putin has in mind, once the oil markets are affected by the EU ban. So we're taking steps today to make sure that the U.S. market is supplied. Second is to tell American oil companies and gas companies that they should immediately take their profits and start increasing their investment back in America. And to increase production, increase capex, increase production. And to do that, we're giving them the certainty that we are going to be purchasing back the oil into the Strategic Petroleum Reserve once prices, if the prices come down towards $70. So the combination of these two announcements today should allow for prices to come down now, hold them from increasing in case something happens, and incentivize American companies to increase capex, investment, and production.
Well, Amos, this is focusing on the crude product, not the distillate. And I know that you guys don't control distillate, so this isn't going to be something in your remit. But we have heard, and we were just talking to Brian Deese, about the potential to restrict export of certain distillates, in particular diesel, as those prices do not come down to historical lows. How much do you think that that could be a benefit to the U.S. to reduce or even ban some of those exports to some of our allies?
Well, that's not what we're discussing at the moment. That's not what we're announcing today. That's a hypothetical conversation that I never take anything off the table, but it's not what we are announcing today or any time in the very near future. So I would put that aside and focus on where we are, which is trying to bring down the price. There is no doubt we are concerned about, on the diesel side, on inventories. We hope that American companies favor and ship their products to different parts of the United States to make sure that we have what we need. But at the same time, we're looking right now to increase our production and to invest back in the United States, because I think the most urgent thing is to make sure that, as we've already seen gasoline prices coming down in the United States, that we continue to see that happening even faster. And again, we can't just have the SPR. We need American companies to increase production and to invest so that we have, across the value chain, we have enough to ensure the American economy continues to be strong and to fight against the inflation concerns that people have.
That's the long term, Amos. In the short term, we do have the SPR. That has been the tool, and it's been a tool that this administration has used. You talk about buying barrels back at the $67 to $72 range at a time when crude right now is $84. We have a long way to go before we get there, and we have inventories at the lowest levels going back to the early 1980s. How concerned are you about a lack of firepower in the one immediate tool that we have if things do get difficult going into this winter?
So, look, I think that we can do multiple things at the same time. I think the point that you're making, that we're nowhere near $70, is exactly why it's time for American companies to increase production. That's not the long term. That's actually the short term. These are short cycles. Investment is already increasing. We would like it to increase more. But the fact that we're at $84, I'm not saying that we're trying to bring the price to $70. I'm saying that if it goes to $70, they know that we are going to come in, the United States government is going to come into the market as a buyer. And that creates a little bit more of certainty for companies as they weigh the risk of increasing investment. So we are mitigating that risk. When it comes to the distillate and to diesel supply, look, we are very concerned. We would like to see and to ensure, the president has been very clear, we want to make sure that the U.S. is protected. And that means to make sure that we have the ability to use the SPR as a tool, which the president has used with enormous effect. It's, you know, if you look at the banks and everybody else, what they're saying about it, it's been enormously effective.
Yeah.
We want to continue to use that. As we go into the winter, we want to make sure that there's diesel and heating oil and gasoline that is available in case there are storms. That is something that we're already paying attention to. And I think American companies should be paying attention to that too and doing their share.
20 seconds, Amos. How did you come up with $67 to $72, a very specific amount for the floor?
Well, I think that we've been having conversations with, look, my colleagues and I talked to the CEOs and the leadership of most of the energy companies in the United States to understand what would serve as an incentive, what would make them feel comfortable about increasing production, increasing investments. And I think this price reflects something that's good for the American consumer and incentivizes American companies.
Amos Hochstein, Special Presidential Coordinator for Energy Security, thank you so much for being with us. Let's stick with energy, and still with us, we do have Invesco's Kevin Holt. He has been looking to add back to an energy exposure on any underperformance. Kevin, back with us now. Is this on a structural bet, or is this on a temporary breach that you're expecting to really escalate heading into the winter?
So, I mean, this is completely 100% structural. I mean, we've spent a lot of time and a lot of investors. The oil industry lost a lot of money for a long time. If you look at Exxon, for example, it's still underperformed the market the last 10 years by 50%. So this is an industry that was very undisciplined. So getting them to earn what we call a cost of capital, to earn cost of capital, to earn the right of investor dollars, you need $75 oil. So that's kind of our mid-cycle pricing, and that's kind of what we look at. It's taken us many years to get the industry to not just be growth oriented and be focused on returns and cash flow. So I think that's what you have. You know, could you go to 65 temporarily? Yes, but for investors, oil demand grows 1%. So you don't need companies growing 5%. We're in a very difficult period with Russia, but you can't just turn supply on and off very easily. It's just very expensive and very difficult.
But Kevin, what we just heard there from Amos Hochstein was pretty telling, that basically he's talked with all of these oil executives, or that the administration has, and they've come up with this range of $67 to $72 as the floor that would incentivize them to invest. How much does that really contribute to your bullish thesis at a time when we're pretty far away from that still, to the upside?
Yeah, I would say, first of all, our reserves are at 40-year low levels. So the SPR is in very dangerous territory. So I commend the administration for putting together a plan to refill it, because we need to, because if something catastrophic were to happen here, that would be very problematic for us. So I think, first of all, you kind of look to that issue. But on the CapEx front, again, we kind of need that $75 oil. I think one thing that people forget too is OPEC, generally Saudi and OPEC countries, they don't have an income tax system like the United States. So, in example, Saudi pays about 85% of their social programs are paid by oil, and they have an $80 break even. So a lot of things acquiesce around that $75 to $80 level. And that's kind of, structurally, I'm a little worried short term with the recession, but longer term, I'm very constructive.
Kevin Holt, thank you so much. Invesco Chief Investment Officer over at the company. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. We can see weakness as the session does grow old. Still down, although not down quite as far as before. The S&P lower by 0.5%. The Nasdaq down by 0.6%. Yields higher as people think out about inflation higher for longer. This is Bloomberg. Breaking a gaining streak with some losses, at least in early trading. Everything can change just in a matter of minutes or hours. S&P lower by about 0.5%, 37.01. NASDAQ down about 0.3%. Yields higher, price on bonds lower. That is the theme. It has been the theme. It has accelerated some today. The two-year yield crossing 4.5%. As we talk about inflation for longer, also how far the Fed could potentially go. The 10-year yield also higher, at one point hitting 4.1%. All of this feeding into dollar strength. We're seeing that across the world, but particularly when it comes to Europe. The euro at 97.77 right now, as we look at some potential weakness in the yields on Italian bonds surging to highs that we haven't seen in a while. The pound also softer, as we did get those PMQs over in London that were pretty brutal. Time now for the trading diary, what you need to be watching this week. President Biden discussing energy at 1 Eastern, followed by infrastructure remarks later in the day. The Fed's beige book coming at 2 p.m. Plus, we'll hear from the Fed's Kashkari, Evans, and Bullard. We heard from Kashkari earlier about the potential for north of 4.75% Fed funds rates. Tesla reporting results after the closing bell. Another round of jobless claims on Thursday, and finally closing out the week with another round of Fed speak, because we did not get enough, from Harker, Jefferson, Cook, and Bowman. This was Countdown to the Open. This is Bloomberg.